I'm Charlotte McLeod with the Investing News Network, and I'm here today with David Garofalo, President, CEO, and Chairman of Gold Royalty, and Ian Ball, President and CEO of Abitibi Royalties. Thank you both for being here online with me today.
Thank you.
Thank you very much.
Yeah, I'm really excited to be speaking with you. And the occasion, of course, is the recent news that Gold Royalty is going to be acquiring Abitibi Royalties as well as Golden Valley Mines. This is pretty exciting news. It's going to create a larger Americas-focused precious metals royalty company. But for those who may not be familiar with this transaction, David, I wondered if you could start off by just briefly going through some of the details there.
Sure. We're actually offering a fairly nice premium to both sets of shareholders. At the time of announcement on the 20-day volume weighted average price was 22% to Abitibi shareholders, and to Golden Valley's about 86%. Given that they're a 45% shareholder in Abitibi, they're benefiting from the look-through of that premium up to the Golden Valley level. We've got lockups from Abitibi shareholders, 65% of committed to the deal, and 38% of Golden Valley shareholders have committed to the deal as well. So we feel quite confident that we're going to get this across the finish line. And what it'll create is a royalty company with nearly 200 royalties across the Americas, 6 of them in production, 7 in construction. So we have a nice organic growth pipeline, both in terms of our cash flow and our royalty portfolio with 191 royalties, runs the gamut from early stage exploration right through to production. So we have quite a bit of pipeline growth within the portfolio on a pro forma basis.
Great, definitely sounding like it's going to be good. So David, we always hear that timing is key, especially when it comes to making acquisitions in the mining space. What made you think that the timing was right to do this deal?
Well, I'll let Ian speak to this from his perspective as well, but the timing for us was fortuitous because we just IPO'd back in March and raised $90 million US in the American market on the NYSE. And that gave us currency to transact, and we completed a merger with Ely Gold, which saw us double the size of our company very, very quickly. And we closed that transaction, and we realized a re-rate through that rescaling of the company. We achieved about a 30 to 40% re-rate for our shareholders as a result of that in terms of stock price appreciation since the IPO. That only further fortified our currency and gave us an opportunity to talk about doing the next deal. And Abitibi and Golden Valley have a tremendous cornerstone asset and a royalty on Canada's biggest gold mine, Canadian Malartic, and that is a foundational asset for us. It represents our gold strike, much as Gold Strike did to Franco-Nevada. This could do for us in terms of a further re-rate opportunity. So we're very excited to bring that in, but also bring in the intellectual capital that comes with that in both Ian and Glenn Mullen, Glenn being the founder of both companies and Ian being the CEO of Abitibi. They've pursued a very successful generative program in Quebec to generate royal opportunities on a very economic basis. So we're not just acquiring Canadian Malartic, we're acquiring a portfolio of other royalties in Quebec and that intellectual capital that Ian and Glenn bring to the table as well.
Yeah, and definitely do want to get Ian's perspective on the timing as well. We've spoken fairly frequently over the years about Abitibi Royalties and the journey that Ian's been taking it on. So Ian, from your perspective, why was the timing right for you?
Well, a couple of factors. David had approached us, so the timing was sort of outside of my control. But on that note, though, the one thing I really liked about it is the fact that Gold Royalty is a new company, and a lot of people didn't understand its assets. And you could look at that either as a negative. I tend to look at it as a positive, because what I really liked was the more I went through the assets, the more I could appreciate the quality of what they had and what they were acquiring with Ely Gold. And what I saw what we had at Canadian Malartic would be the cornerstone asset, but you put a cornerstone asset into a broad-based portfolio, and I think it enhances the value across the board. So I really liked that part of the story, recognizing that it wasn't a well-known company. And then I looked at the skill sets that Abitibi had and felt that, there is going to have to be a changing of skills to bring it to the next stage of development. And if you look at David's history, certainly has the required skills that Abitibi did not have. And so on the asset level, the personnel level, it made a lot of sense. I think what's really most important, and you don't see it very often in the mining industry, the stocks of both or all three companies have gone up. Usually the acquirer stock drops, and with that, there's only a small premium. Where here, the share prices of all three companies. So I think what you're seeing is the company is starting to emerge from the mid-tier royalty package, because I do think it has the broadest base of royalties across the spectrum, being led by that cornerstone royalty that so many of the peers currently lack.
Right, and you mentioned the share price performance, which I know is something you've really focused on at Abitibi Royalties. So maybe you could speak a little bit more about that and how that will fit into the picture moving forward.
Well, for me, it's very simple. When someone, usually when you put two companies together, there's social issues. Who's going to be running the company? And when I looked at it, it was purely from a share price perspective, saying, well, social issues shouldn't get in the way, because if you own enough stock in the company, like I looked at it and my investment was worth 20 times my salary. And the fact that the share price goes up, that makes the decision process very easy, that you're not worried about. All you're worried about is your shareholders and the share price. And I think that's something that's kind of been lacking in the mining industry, where a lot of deals probably should have happened and they haven't, because of those social aspects have gotten in the way.
Okay, and over to David. So this is not the first set of acquisitions for Gold Royalty. You mentioned earlier this year the Ely Gold combination. So what does the path forward look like? Is there more in the future? What's the end goal at this company?
Yeah, look, there's been a proliferation of royalty companies that come into the space in the last couple of years, and that's anticipating that there's going to be an acceleration of mine development. The operators have underinvested in exploration and development over the last half a dozen years, and that means declining reserves and production. And the royalty companies have always been an important part of the ecosystem to provide capital to the emerging producers, the explorers, to further their assets, de-risk them, and ultimately bring them into production. But to be effective in that role as a royalty company, you have to have a low cost of capital, and scale matters. It attracts a higher multiple, attracts a lower cost of capital. So achieving scale was always an important objective for us, and doing it quickly so that we could become relevant and drive down our cost of capital and provide opportunities for emerging producers and developers to further their assets. So, we'll look at a broad array of things, whatever it creates value for our shareholders in terms of net asset value, in terms of cash flow per share. That's what we'll focus on. It could be M&A, it could be individual royalty opportunities. We've done a combination of both. We did the Ely transaction. We're doing this three-way merger. We also acquired royalties from Monarch and from Alamos on individual assets to continue to grow the portfolio. So we have our eyes peeled for whatever creates value for our shareholders. And like Ian, we're owner operators. I'm a founding shareholder of the company. Amir Adnani, who's on my board, is a founding shareholder. Warren Gilman, who's on our board, is a founding shareholder. Ian will become a significant shareholder of the company post the merger, as will Glenn Mullen. So you'll have that owner operator mentality really throughout the entire organization.
Yeah, and Ian, I think we've talked in the past about the increasing number of royalty companies in the space. It started off with not too many options, and now it seems like there are many more. So what do you think about that? Is it a space that's getting a little too crowded? How do you see that playing out?
Well, I think the number one thing you have to focus on is exploration. Exploration is what drives the value in so many of these assets. So if you're buying an asset just simply for the cash flow, and that cash flow is going to stop, I think it's a very short-sighted. What I like about the royalty companies and what I like about this portfolio is the optionality value. Do they have big land packages around the existing mine? Do you have strong operators to keep reinvesting? And right now, what you're seeing is that a lot of the newer royalty companies are acquiring royalties on weaker operations, because that's where the capital is currently needed. So I think I just look at the pipeline of exploration that's within the company, and I'm not saying it will do nothing, but I do think that the combined company could literally do nothing for the next 20 years, and it would have a very strong profile of growth just based on the exploration that we see. But the important point is, I think if it's getting crowded, how do you stand out from the crowd to get the eyeballs on your company versus all the other royalty companies? And you got to do things differently, because if you follow the path of all the other royalty companies, you're going to get the same result, and that's probably a mediocre share price. So you have to think differently. You got to get a lower cost of capital, a higher rate of return. And like I said, you just follow that path, and unfortunately, you become just a Me Too company. So I don't think that's the plan here, though.
Okay, and something that I think is true for both of you is you are in the royalty business now, obviously, but you came from more traditional mining companies. So I want to ask about making that switch and what prompted it, maybe starting with David for this one.
Yeah, just having completed the merger with Goldcorp and Newmont back in 2019, that created the world's biggest gold company by market cap and production. What I saw across the landscape was a dramatic underinvestment in exploration and development, and that culminated in a 40% decline in reserves since peak reserves about 6-7 years ago. So what I foresee is a tidal wave of investment back out of existential need into mine development. And what I think that means, particularly against a backdrop of inflation in the general economy, is massive input cost inflation coming. We had tailwinds in the mining business of lower energy prices, depreciating local currencies. That's reversed. Energy prices are going up. Local currencies are accelerating against the US dollar. And I also see the potential for inflation generally, labor costs. We're seeing it in our everyday life. And given the constraints, capacity constraints in the mining sector, base metal companies and precious metal companies are building mines at the same time as they did 10 years ago. We're going to see double-digit inflation input costs. So the royalty business is where you want to be from a couple of respects. One, providing capital to those developers and explorers because they're going to need it, but also insulating shareholders from cost inflation because we take top-line exposure. So we're like an ETF or a physical gold bar, but with exploration upside. That's the beauty of the royalty business. It gives you the best of all worlds while insulating you from the most significant risks in our business as I see them today.
Right, and Ian, maybe you could speak to that as well, that shift from the more traditional
mining. My answer is a little more simple. I was spending all my time working on problems on the operation now. My problems were probably pretty small compared to David's running the largest gold company in the world, but mine felt pretty big at the time. So I just thought that rather than using all my energy to solve problems, I thought there was a better way to create value. And doing that on the operational side, I find is very difficult. So that's why I switched to the royalties, because I thought there was more creativity, energy that could be put forward. And because at the end of the day, I think what people forget is, although we're a gold mining company, you're here to create capital gain for your shareholders. And I just felt that I would have more ability to do that on the royalty side than on the operation. But I have to say, though, without having that operating experience, I don't think you can successfully run a royalty company.
Okay, and as we're getting to the end here, I do think it's important to put this deal into the context of what's happening in the gold market overall. I know there's been some disappointment in its performance this year, but there are plenty of people who do see a bright future. So first, starting with David, what do you think are the most important drivers for gold right now? And this is a tough question, but what is 2021 looking like for you as we move forward?
Look, I think it's lower interest rates for longer, quantitative easing for the foreseeable future. And given the amount of debt that's been strapped on by governments globally, it's inevitable that they're going to debase their debt by debasing their currencies. So we're going to see continued printing of fiat currencies. I see no reason in this inflationary environment, and this is not transitory. I don't believe that for a moment. I believe inflation's here to stay, and it's going to rival what we saw in the 1970s. And perhaps surpass it, given the coordinated effort that's being occurring across all the central banks globally to debase currencies competitively and preserve export markets. Gold at that time achieved $850 an ounce. That was the real all-time high, believe it or not, because if you inflation adjust that to today's dollars, that's $3,000 an ounce. That's what I foresee in this cycle in the short term. I'm talking about months, not years away. What happens beyond that will really be driven by whether there's going to be a tapering in monetary policy or not. If it's a continued amplification of stimulation, I think gold has no ceiling. It's very, very difficult to foresee where it'll end up.
All right. And Ian, we last spoke, I think back in March, and at the time you told me you were surprised the gold price wasn't higher. And since then, I've had more and more people
Did I
telling me
say
that.
that? I don't
So
know.
yeah, so more and more people definitely telling me that now. So what do you think is holding gold back? What are you seeing right now? Your updated thoughts?
It's tough to know. If you look at for me, the key driver of gold price is the US dollars, is the M2 money supply. And there's always been a very strong correlation between the amount of money that's being printed and the gold price, because gold is money. And if you look at maybe what a fair market value of gold should be today, just based on the current money supply, you're getting close to $2,100 an ounce, give or take. As David said, they're going to keep printing. If you look back to the 1960s and you think of, when JFK was president, right? He would ask, what can you do for your country? No politicians today are asking people to sacrifice anything. All we do is give, give, give. And that means printing more money. And, I think that trend is going to, if you think about it, in 2000, we had $4 trillion in the monetary system in the United States. And today we're at over 21 trillion 20 years later. And you say, okay, in 20 years, we've had the money supply go up by 4 or 5-fold. Where are we going to be in the next 20 years? Are we going to be at 100 trillion, which would put the gold price at $10,000 or more? It's a pretty staggering number. And what's happening right now, the governments are, in my view, essentially are stealing from their citizens by the amount of money that we're printing. So gold really should play some part of a portfolio in terms of the wealth protection for every investor.
All right. Well, I think we've gone through the deal. We've looked a little bit at the gold market. I want to open up the floor just before we finish to both of you to see if there's anything else you want to mention before we close out. And we can go first with David and then over to Ian.
Look, we're delighted to put these companies together because of the quality proposition we're offering investors. Among the sub $1 billion market cap companies, we're going to be the biggest by market cap, the biggest by in terms of the size of the royalty portfolio, the strongest balance sheet with about $50 million in cash and no debt, and trading liquidity that really is beyond the pale. It's certainly the highest among our peer companies as well. And again, that all drives us to the potential for a dramatic re-rate in our stock price, lowering of our cost of capital, which allows us to continue to perpetuate our business and grow it. I'm very excited about the prospects of this merger and what we're going to do on a combined basis together.
All right, and Ian, any last words?
Yeah, I would just end by saying, when you look at the management team at Gold Royalty and you look at that sub $1 billion market cap, I think it's, if not the highest, one of the highest quality management teams in a space that, as you mentioned, is getting quite crowded. You look at the shareholder list, with Eric Sprott being the second largest shareholder pro forma, Rob McEwen being there. You have Ian Telfer, who's the chairman of the advisory boards. I think you're going to have a lot of eyeballs looking at this company. So to your point earlier, how do you stand out from the crowd? I think it's the quality of the management team and then looking at who is invested in the company.
All right. Well, thank you so much for being here. It was great to hear more about what's going on. Once again, I'm Charlotte McLeod with the Investing News Network, and I'm here with David Garofalo and Ian Ball.